Indeed. We really hit a crescendo in terms of the corporate earnings rollouts in Japan this week. Some of the biggies: NEC, National Electric Corp. I think that's what they were called in my day and age. NEC for short now. Sharp and Fujitsu. They make Fujitsu General products as well. All out today. And then there's the baby of them all, Sony. Mike is here with the preview. Sony beat us again. It's a Sony. That kind of brings reminiscent, doesn't it, of the 70s and 80s. Mike, actually, would you remember that?
Yeah, we're the same age, Bernie, so sadly, yes, I can remember it all too well. Anyway, analysts are saying that Sony will probably report its second straight quarterly loss because of weak demand for its TVs and its video game consoles. They say it lost the equivalent of $842 million in the 3 months through June 30th. A year earlier, it earned a profit of $368 million.
I think the outlook is really tough, and it's hard to be optimistic. It's difficult to say when the economy will bottom out. All I can say is it's bad.
Sony's lost the lead to Samsung Electronics in the LCD TV business, the yen rising 34% against the Korean won in the year ending June 30th, which makes the Bravia TV comparatively more expensive than those made by Samsung. Sony is forecasting a full-year loss of $1.3 billion, which would be narrower than last year, but not by a hell of a lot. Chief Executive Howard Stringer is trying to limit the red ink. He's cutting 16,000 jobs. He's shutting factories. He's halving the number of Sony's suppliers. He has so far resisted pressure to cut the price of the PlayStation 3. It costs $400, about twice as much as the Xbox 360. Game makers say that is discouraging buyers, which hurts sales of their software. Sony, though, doesn't want to discount the PS3 because it's still losing money on every console that it sells. US sales of PlayStation 3 down 59% last month. Also, Wii fatigue appears to be setting in the Nintendo console, down 46%. Sony ending the morning session today at 4.1%. Year-to-date, shares up 27%. We've also got earnings today from Nintendo, ending the morning session up 1.3%. Year-to-date, though, down 22%. Well, John Alcar is in the studio with me. Morgan Stanley Asset Management quite likes consumer electronics stocks, about a quarter of the portfolio. And of those, you've got 2.9% Nintendo, 2.4% Panasonic. No Sony, though. What do you like about Nintendo and not Sony?
I can't talk specifically about each of these companies, but I think what we like, for example, in the case of Nintendo, would be the balance sheet quality. It's phenomenal cash, as you know. The stock has done absolutely nothing this year. It's been dead money. And maybe this earnings release, which may be slightly more positive than expected because of the currency differentials that they had from their first estimates a few months ago, might cause a re-rating in the stock. But we do like the consumer electronics sector.
But aren't you only as good as your latest product? You know, Apple is coming out with great products time and time again. Sony's been criticized for years now for not coming up with a new Walkman, and everyone who wants a Wii has probably got one now. So what are these companies doing to come up with new stuff?
I think, well, I can't, like I say, specifically about the companies, I can't say, but generally, I think one has to look at the restructuring efforts that are being made. And in the case of some of the companies you mentioned earlier, these are quite significant. I think there's some hope aspect that they will get it right, and they are turning the corner, and they will be coming out with new exciting products. And the stock market's rewarded these shares accordingly since the beginning of this year, as you pointed out earlier, much more than the overall market as a whole. So,
Bernie.
John, you know, when you talk about call option, you know, as a proxy on China, sort of the aspirational crowd, are you talking about things like this, consumer electronics? I mean, upgrading lifestyles and hopefully nailing down some leisure time on top of 60-hour work weeks, or are we talking cars? What exactly what exactly do you have in mind?
Murray, I think it's the whole broad spectrum of goods and services that Japan exchanges with China. In fact, I would mention one footnote here. The Japanese are the only people among G7 that have figured out how to make money off. They have a trade surplus off the Chinese government. They're the only country that actually have a trade surplus, which means that they've learned how to, arguably have a good trade flow with them. And where we think there are some very exciting opportunities, as I said earlier, when China starts to upgrade their factories, more automation, that's where Japanese devices could and are playing a very big role in that part of the food chain.
You and I have talked about, I mean, and we have several very illustrative kind of examples of how competitive you feel that the market is. And I think we've already kind of pinged through a few of them in the earlier section, like historical price-to-book levels and the fact that it's just been coming down and down. You know, you look at the topics versus historic PBR. First section, production cuts and the excess capacity has been taken out of commission. I want to talk a bit about the leveraging, though. Remember, last time we spent a lot of time talking about the fact that, like, 4 out of 10 companies have zero debt. Right. 4 out of 10 topics companies have zero debt. I mean, zero leverage, so they don't have that kind of at-riskness that a lot of other companies. But when you're in a benign environment like we are right now, does that behoove them to maintain that kind of capital structure?
I think that is changing slightly. What has happened over the last 18 months and what's been particularly noteworthy over the last 6 months is the number of M&A activity you've seen from Japanese companies. And whether the headlines of Suntory and Kirin or the Hitachi Group, you know, buying back their outstanding subsidiaries, or the huge M&A activity that has gone on for Japanese companies purchasing companies outside of Japan, that's where they're using their lack of indebtedness these days to capture the next growth phase, in my view. And that's very significant.
Now, you've been saying that Japan's the most economically sensitive of the world's major indexes. I mean, people now talking, it may be a cliche, talking about green shoots of recovery in Japan, in the US, and elsewhere. What does that mean for the Nikkei and the topics?
It means it probably has further to go. And by reference, I would go back to, say 1992, 1995, 1998, and 2003. These were all cyclical rallies that we've had in Japan, each of them ranging from 50 to 140% from peak to trough. And the relationship of the market capitalization at that time to GDP was about 50%. In other words, GDP was 100, and the stock market cap was about 50, 55% of Japan's GDP output. Today, the markets are about the same level. They're about 50, 55% market capitalization as a percentage of GDP. The past peaks of these cyclical rallies have resulted anywhere between 80 and 100% of market cap to GDP. Which, so if you go through that analysis, we've come maybe 35, 40% off the bottom, and it suggests there's more to go. But I think fundamentally, a point I'd like to make here, which in my view is very important, is the lack of ownership of the Japanese market. And that is very, very significant today.